This shouldn't be happening. China just moved 200 tons of silver quietly. No headlines, no panic. But when silver moves like this, something always breaks next. This is why physical silver is disappearing and why the price is lying to you. What just happened is more than just a large transaction. It's a signal. The Chinese government, or entities closely linked to it, orchestrated a massive withdrawal of physical silver from global vaults, 200 tons. And they did it without making a sound. Why does the quiet part matter so much? Because when governments make big moves, they don't want to alert the market. They don't want you, the retail investor, to know what they know. This reinforces a critical truth. Retail watches the price, but governments and institutions secure the physical supply. They're not speculating on the daily price flicker on a screen. They're acquiring real, tangible assets. They're playing a completely different game, one based on long-term strategy and physical control, not short-term paper profits. This move wasn't for a quick trade. It was a strategic acquisition, a quiet stockpiling of a critical industrial and monetary metal. They know that in a crisis, holding the paper contract isn't the same as holding the bar. And right now, their actions are screaming that they value the physical bar far more than the current market price suggests. Now, let's put this into perspective, because 200 tons sounds like a lot, but just how huge is it really? The world mines about 26,000 tons of silver each year, so 200 tons is nearly 1% of the entire annual global mine supply, taken out in a single, quiet move. Imagine 1% of all the new cars made this year just disappearing from the market overnight. It would cause chaos, but with silver, it's more subtle. The system is built to absorb these shocks, but only up to a point. Think about the logistics. Moving 200 tons of silver isn't like wiring money. It requires trucks, vaults, security, and immense coordination. It puts a real physical strain on the delivery and storage capacity of the entire system. Places like the comex warehouses, which back the massive paper market, feel this pressure directly. When a huge chunk of deliverable silver is taken off the market, it reduces the buffer that keeps the whole system stable. This is why the saying goes, silver doesn't vanish loudly, it vanishes early. The big players, the smart money, don't wait for the public announcement of a shortage. They move first, securing their supply, while everyone else is still looking at the price on the screen, thinking everything is fine. This 200-ton withdrawal is exactly that kind of early move. This brings us to the core of the issue, the massive disconnect between the paper market and the physical market. Most people who think they own silver actually own a paper claim, a futures contract, an ETF share. These are traded on screens in immense volumes, and that's where the price of silver is determined. But that price is based on the assumption that for every paper claim, there's a real bar of silver sitting in a vault, ready for delivery. What happens when that assumption is tested? This is the critical vulnerability. Price discovery happens on screens, but shortages happen in vaults. The paper market can create trillions of dollars in notional silver value out of thin air. But you can't build a solar panel or a microchip with a paper contract. You need the real metal. When a massive physical withdrawal like this happens, it's like someone calling the bluff of the paper market. They are exchanging their paper claims for real physical bars. And every time a bar leaves a registered warehouse, the foundation of that paper pyramid gets a little bit weaker. The ratio of paper claims to physical metal grows, and the risk of a delivery default, a failure to deliver, gets higher. This is the ticking time bomb at the heart of the silver market. History gives us a clear pattern for what happens next. This isn't the first time a large, quiet removal of physical silver has occurred. And every single time it has been a prelude to a significant price move. Look back at the periods before major silver spikes. You'll often find reports, usually buried and ignored at the time, of large drawdowns in physical inventory from major exchanges. There's a delay effect. The removal happens, the market yawns, and then weeks or months later, when supply chains tighten and industrial users can't get what they need, the price suddenly explodes. Why? Because the supply shock was already baked in. It just took time for the consequences to ripple through the system. Every silver squeeze in history starts with silence. It doesn't begin with a Reddit forum or a trending hashtag. It begins with the quiet, methodical removal of physical metal by those who know its true value. They drain the vaults while the price is low before the panic sets in. What we're seeing with this 200-ton move by China fits that pattern perfectly. They are acting before the crisis, not during it. So what should you be watching for next? Forget the daily price chart for a moment. That's a lagging indicator. The real signals are found elsewhere. First, watch the premiums on physical silver products like coins and bars. When the gap between the spot price and the price you actually pay for a physical ounce starts widening, it's a massive red flag that physical supply is tight. Second, keep an eye on delivery delays from major dealers. If you order silver and are told you have to wait weeks or even months to get it, that's another clear sign the system is under strain. Finally, follow the inventory reports from the major exchanges like the COMEX and the LBMA. Look for the registered or eligible silver categories. When those numbers consistently trend down, it means more and more metal is leaving the system that backs the paper market. These are the signals that precede the headlines. The mainstream media will only report on the silver shortage after the price has already skyrocketed. By then, it's too late. The moves are made in the quiet moments beforehand. If you want to get the signals before the headlines, you need to know where to look. Thanks for watching. The game is changing, and the quiet moves are often the loudest signals. If you found this breakdown helpful and want to stay ahead of the curve, make sure you subscribe to the channel. We'll keep tracking the data that really matters. See you next time.